like the thing about stockholder equity is it's like the basis of like what it's all about, really, because essentially there's these entities, these business entities, these corporate structures. Like a lot of times they're gonna most likely be a C corp, unless, for example, like they're an S corp for whatever reason. Double taxation stuff, like, I don't know, I mean, if it's like a larger organization, they're most likely gonna be a S corp. But so like there's LLCs, so props, C corps, like C corp, essentially like the way they're taxed. I forget, like, oh yeah, like, gosh, what is it, like they have it be taxed because like the way that they distribute earnings, or like the way that they plan to like tax those earnings. Like you can get taxed like the way, like, because like for example, like you might, one of the main reasons why like a corporation might have a certain way it's set up is because like, oh, really the way that, you know, we're making money is like we're working for the corporation, so like we don't actually get any kinds of like distributions in regards to like earnings, you know, with regards to like the stock, like the dividends from the stocks, like there is none. So like in that way, like we don't really, we like, so then like if for example, like we don't want to get taxed twice, like you get taxed like at the distribution level, at like the when it gets dividends, and then like there's like the taxation in regards to like the earnings from like those dividends. So like you could, oh yeah, we're gonna tax it at like the dividends, and then we're gonna tax it when you get the dividends as well. I don't really know why they would be like, oh, S corp, like I forget which one, but essentially there's like a whole bunch of stuff regards to like C corp, S corp, for whatever reason, like, and like the way they're set up, like the S corp, like I guess it's better for like, because like they're not gonna have earnings, as in like they're not gonna be earning a salary, because most of it's gonna be like shareholders actually. So like the shareholders, and like the shareholders, the owners are gonna be like not really necessarily gonna be working for the company. So like I guess it doesn't matter, because like they're not gonna get taxed from like salaries, or like or like earnings from like salaries and dividends. So like I guess like they'll be like, you know what, let's just have it be taxed like only once, or like they could tax it twice, I don't know. But anyways, there's a big difference between S corp and C corp. I kind of forgot what the difference is, but like you guys could look it up. But like on that level, because like other than that, you most likely have like a LLC, which is like membership. Like these are like well, they all have limited liability, but like essentially it's member managed versus like shareholders. And then like really, if you want to have like any type of like shares, you're gonna have to like have it be either S corp or C corp. But essentially, like that's one of the main things, is like this organizational structure in regards to corporate organizational structure. So like they build this up, right? And so like it's a setup. They set up this like organization, and then that's like the basis of like how it all works, and like in regards to like distribution of earnings. So like if it's membership managed, they have like a percentage of like the ownership of the members. Like each member has a certain amount they own. So like if there is some type of like revenue, I forget what it's called, like shareholders equity, revenue essentially would be part of that. Like they'd be like, oh yeah, we earned like 100,000. The company after deductions, after all the expenses, we'll put that into shareholders' equity, and now like the shareholder equity has gone up 100,000. So it's like, how do we distribute that? We distribute that based off of the partnership, based off of like how much each member has, like the percentage of that. So like you guys can see like why like shareholders equity is so important, but like that's only in regards to like partnerships. So like partnership usually means like, oh, there's like a few owners that like have majority ownership of the company, and then like based off of that the earnings of the company is distributed based off the percentage of ownership, and like these owners might own like a large share of the company itself. But the thing is, and the reason why shareholder equity is so important is because of this thing called stock, essentially. I don't know if you guys ever heard about it, but like that's really one of the main tools that organizations, companies have. Like it's a tool that they can use to sort of give the entity kind of gives up parts of itself to, for example, raise funds. It's like one of the things that they could do with it. It's like a tool. Like why would they want to like have stocks outstanding? Well, they did that to raise money. Essentially, is really the main reason why they would do that. They issued these stocks to raise funds. So it's like a way of raising capital. So like they issue these stocks outstanding, and then they put them out into the secondary market, because there's like a primary market which they could have like a private stock market type of thing, so like private sales of these stocks. But then the secondary market essentially would be the stock market, and then stock market. So like essentially, if they're gonna be out on the stock market, most likely it's gonna be an S corp, because like there's gonna be a lot of stockholders. There's gonna be many owners that own like different parts of the company, like various shares of the company, various percentages of the company, and they have like rights based off of like the type of stock they have. They have common stock, they have preferred stock. Like there's a big difference between preferred stock, common stock. Like preferred stock, you like get paid out first from like the dividend payouts. The dividend payouts, essentially, it's not like a guarantee. They're not just gonna be like, oh, we have to pay you. It's like they'll say like, you know what, we're gonna pay like a certain amount, but they pay the preferred first, and then whatever's left they'll pay out to like the common stockholders. And so like, yeah, that's really the gist about stockholder equity, why stockholder equity is important, besides the point of it being like this repository for where like the revenue goes. And of course, like if there is like a liquidation of the partnership, liquidation of the company, then they would also share in the losses of the company. And like you guys can figure out like, oh, based off of like the owner's equity, we're going to distribute the losses from the liquidation of the company. But besides that, so like that's like the gist of stockholders equity, why it's important. But then like now, like, okay, so like now there's like shares, you know, it's like now this thing exists where it's like common shares and like preferred stock, you know, shares, blah blah. So like they can do all sorts of things with these, especially like regards to like bonds. Like they can even issue out these stocks in exchange for a bond. They could actually like exchange stocks for like all sorts of things. Like they could put it out for a note, they could put it out for like equipment. But like these shares, like, and then there's like percentage interest rates for like shares. And then like there's also things in regards to like treasury stock. If the company buys back stock, like their own stock, no longer is it outstanding, but rather that it's treasury because they bought back their shares from the open market. There's all stuff like that. Conversions, block split. If they plan to like do a stock split of the company, then it's like, oh, now all of a sudden like the outstanding shares have like doubled in quantity, and so like then whatever it was at par, like they issued it out at par. Like they're saying, oh yeah, you know, this stock is gonna be like $1 per par, and then but like the thing is like the market create of it gonna be like, they actually it's a par as like this thing that they say like it's worth, like the MSRP of the stock, and then like actually when they put it out on the open market, the fair value of the stock is actually going to be like whatever amount. So it's like, there's additional paid in capital from the issuance of the stock. So like they issued out 1,000 shares at $1 par, but then the thing is the fair market value, the market decided that those stocks are worth $10. So like the additional paid in capital is $9 per share. So there's $9,000 worth of additional paid in capital, things like that. They can do like conversion of the stocks, exercising stocks, like that stuff I don't really know that much about, but like essentially that's like a really big thing about intermediate accounting 2 is shareholders equity. I'm not really sure about intermediate accounting 3, but then you guys need to like understand the concept of like stocks and shares, and like because that's like one of the main ways that these organizations, these corporate entities distribute earnings, via like dividends, and share in the profits as well as the losses of the company. So shareholders equity is very important. I wouldn't, if you guys don't understand it, because it's kind of hard to understand, I would try like spend a little more time to like grasp the concepts behind it rather than like try to avoid learning about it, because like there's a lot of stuff about it that's like really important. But besides that, I mean, because there's going to be some more stuff in intermediate accounting 3. I'm not really exactly sure what it's going to be, but once you guys understand stuff about shareholders equity, that's a really important thing. So like once like that's like figured out, and then there's like you can talk more about it, but essentially like it all comes together, and then you guys have to understand like the reasons why it exists. Like for example, like the 10K and 10Q and like the SEC and the IRS and like how they all do that, and like the FASB and all that, like the reasons why they have to like use GAAP. So it's like it comes full circle. But like essentially shareholders equity is really important because like that's what they would use to like calculate various things. So that's something that's like a key concept. Like it's such an important concept to learn and to know, and that's like it's like one of the key concepts to understand in regards to like business, and like basically how to like do journal entries for that, how to like write all that stuff down, the stuff they're doing. Okay.